All right. Welcome to the show, TSP Weekly Podcast.
It is the end of July. Kind of amazing. It's been an amazing year for the markets for sure. And this week was a big week. The data just keeps rolling in, and it's kind of controverting some of the stuff that it's in the news, and it's really hard to kind of keep everything in focus. I think if you're not looking at charts, it continues to amaze me that the talk is about the current events and people aren't looking at what is actually happening, and it just creates this big disparity basically between fear on the one side. There's a lot of fear on the one side and a lot of greed on the other side.
Yeah, it's pretty rare when you watch television for them to talk about where the price actually is and what that means. They're not, even if they are familiar with technical analysis, they're not talking about it in mainstream media. So the only way they know how to talk about this stuff is what the news is and why that should be impacting such and such, and then just making stuff up from there. Because we all know that's all just crystal ball stuff anyway. None of it means anything. So yeah, that's not surprising to me actually, that the mainstream folks would not understand what's going on. Like, why is it not doing what it's supposed to do? Well, it doesn't matter. It just doesn't matter. Look at the price, and that's what it's doing. So.
Yeah, it's interesting because we're going to get to a chart of Tesla Tesla was down 8%, had really, really bad earnings. We're going to talk about that, like just as an example, because Tesla is in the middle of making this triangle pattern, and there are no guarantees which way the market is going to break on a triangle pattern, but there's a structure there that when it breaks one way or the other, then you know which way it's going. So it's really helpful because it usually breaks in the direction of the prior trend. And so everybody is all about this idea that Tesla put in like the worst quarter in like 10 years this year, and the price was down 8% yesterday. But the chart is showing you a different kind of setup. So we're going to get to that. It's pretty interesting. It's just an example. I'm not saying to buy or sell Tesla. It's just a really good example of technical analysis right now. All right, so
let's get into it.
All right, TSP Podcast, 27 July 2025. So we'll look at what happened this week. The biggest thing was the Japan trade deal. That was really big news this week. We also had huge earnings reports from Tesla on the one hand and Alphabet on the other hand, Google. And we're going to look at impulse versus corrective patterns. So that kind of goes to what I'm talking about in Tesla. It's really important. If you see price go up a lot over the course of a couple of days, that is an indication of an impulsive wave. And corrective waves correct that impulsive move. So knowing which structure you're looking at can really help with TSP decisions and the TSP fund charts. So Monday, we've been talking about the bond auctions that are going on all year. This week, we had another 3-month and a 6-month bond auction. And so this week, we closed out at 4.240, right? It's a little bit lower than last week's, which was 4.245, and a little bit lower again than the week before that, which was 4.255. So it doesn't seem like much, but it's going in the right direction. Every week that we can do bond auctions that have a lower interest rate, the less we're adding to the deficit. So that's a good thing. And the same thing on the 6-month, right? We had 4.115 versus 4.125 last week, 4.145 2 weeks ago. So the bond auctions are going in the right direction, even though the Fed is yet to lower rates. And S&P was up 0.14% on Monday. And Tuesday, we get the Richmond Fed Manufacturing Index. So over the past couple of weeks, we looked at New York and Philly. And this week, we got the Richmond Manufacturing Index. It sank 12 points from the previous month to minus 20 in July. It's the lowest in 10 months. And it's in sharp contrast to what they expected. They expected it would improve to a minus 2, but it's a minus 20. we're going to take a look at the chart of that in a second. And then M2, there are analysts that build their whole service around M2. It's money supply. It's a complicated, it seems very simple, but it's kind of a complicated idea. What money are we actually talking about? But I'm going to show a chart of that. When the money supply, which is put into the system by the Fed, it usually rises. But when it starts to contract, the market contracts. That's why there are analysts that only use M2, and they are fully invested when M2 is rising, and they're fully out when M2 is falling. But this month, we're up 21.94 trillion versus 21.86 trillion last month. So M2 continues to rise, and the stock market continues to rise. There are all these things that make the market move, and most of them are noise. Obviously, $22 trillion and rising is one of, if not the biggest impact on markets. And the S&P was up 0.06% on Tuesday. So this is the Richmond Fed. Okay, there's the manufacturing side of the economy and the services side of the economy. So this is a 10-year chart. So as you would expect, coming in, from 2016, the economy is doing really well. Manufacturing is growing. The zero line, if you're above the zero line, it's growth. If you're below the zero line, it's contraction. And so the economy is growing 2016 into 2018, and then starts to fall off. And then COVID, right? Everybody was locked down, so we had a big sell-off, and then the rally once the Fed turned the money spigots back on. And that went until about the middle of 2021 and started to decline again. We had an uptick, we put it in a bottom in 24, had an uptick going into 25, but then it's been declining ever since. So, and now we're back down to minus 20, and they thought it was going to improve. The expectation that it was going to be up here at minus 2. So at least in the Richmond region, the manufacturing is deteriorating. And then M2, right? It almost always goes up, and it goes up generally on a slope like this. COVID, right there is when all the money started pouring in from the Fed, and it kept on going, right? All this money that got pumped into the economy until it peaked in 2022, and then the Fed started to cut back on the amount of printing and pushing money into the system, and M2 rolled over. And it's no coincidence that was, the bear market in 2022. And it stabilized in 23 and picked back up at the end of 23 and continues to rise. So as long as M2 is rising, the stock market goes up. It's not a day for day, but as long as M2 is rising, the market's going up. Wednesday, we get 30-year mortgage rates rose a little bit. I'm kind of surprised. I expected this week to be higher on 30-year mortgage rates, but they're up 6.84 from 6.82 last week. New applications were up a little bit, 0.8%, but they had fallen 10% last week. Existing home sales were way down, 3.93 million versus 4.04 million last week. So not good for housing. S&P is up 0.78% on Wednesday. Then on Thursday, we get another really good number for initial jobless claims at 217,000 versus 221,000 last week and 228,000 the week before that. And if you remember, a few weeks ago, unemployment had fallen from 4.2 to 4.1%. So we continue to get really strong employment numbers. And as long as people remain employed, it's really, really hard for a recession to get triggered. There can be all kinds of data that's pointing to recession, because we still hear about it. That's like the fear crowd. But as long as unemployment stays low, and particularly you'll see it in initial jobless claims first. If this thing spikes up to 317, then the data will start to to backfill, and a recession is much more likely. But as long as you're around 200 to 250,000 a week, there's no recession happening. And then Friday we get durable goods orders. They were up 16.4% month over month last week, but they're forecasting for a minus 9% this week because of tariffs. So it's going to be interesting to see how that comes out, because most of the data from tariffs is showing that, at least as of now, tariffs are not having a negative effect on the economy. Okay, but the big news this week definitely was that Japan trade deal. So the trade deal gets announced on the 23rd of July, and it reduces most of the U.S. tariffs on Japanese goods. Originally, there was the 25% was what was threatened to Japan, and that got pulled down to 15%. But there were a lot of things in the mix with that. Autos was probably the biggest one. But in exchange for bringing that tariff rate down from 25 to 15%, Japan is going to invest $550 billion to the US. So they're going to fund projects. And the administration is going to kind of hand select the projects that Japan is going to finance for us. And a lot of that is going to be pharmaceuticals. Some of it is semiconductors, but a lot of the talk is about pharmaceuticals. It's a very creative, apparently Japan came to the table with this idea that they would fund it and we would execute it, and then the US would actually get 90% of the value of that funding, and Japan would get 10%. So it's something that you would do on Wall Street, but it's not something that you usually do between countries. So it's pretty creative. They're going to open their markets to US auto manufacturers, which Japan doesn't really buy US cars as it is. So I don't know if that's going to matter for domestic auto selling to Japan, but that's part of it. And then some lock-in protections. And this was kind of an interesting one, the additional commitment to purchase US military and civilian aircraft. So Boeing made out really well with a commitment to buy 100 planes from Boeing. So that was the biggest deal. That really kind of kept the market from falling off the edge, I think, this week. And the other one was really a huge earnings week. So about 83% of the S&P 500 companies reporting so far this quarter have beaten their consensus estimates. It's not really unusual, but everybody's kind of anticipating the quarter when earnings go down, and this quarter is not going to be it. Year over year earnings growth is kind of moderate. It was only up 5.6%. It's the slowest quarter since Q4 2023, but it's still positive. Alphabet had a huge earnings. Shares were up 3%. That was mostly based on their cloud revenue, up 32%. It's all about AI and ad growth. The kind of the opposite of that was Tesla, right? So after earnings, Tesla dropped 8%, and it was down 11% at some point in the aftermarket that day. But it was the sharpest fall since June. Revenue fell to 22.5 billion. Way missing estimates. Tesla's largest year-over-year revenue drop in over a decade. So Elon Musk comes out and cautions that the company may face a few rough quarters, which is code for we're kind of in trouble, due to macro uncertainty, expiring EV tax credits. So we had $7,500 EV tax credits on electric vehicles, and that expires, I think, the end of September. And then, of course, tariffs and regulatory questions. The one positive was they're going to launch a new, cheaper Tesla, which will be interesting to see how the market responds to that. And the robo-taxi service is apparently really taken off in Austin, and they're trying to expand it to other cities in 2026. So Tesla is an interesting one. All of this is not good, right? There's nothing good in the earnings report about that, which is why the stock tanked. And we're going to get to that in a chart here in a second. But this idea of impulse versus corrective patterns. So this is kind of a textbook. This is a pretty good reference for the difference between impulse and corrective waves. So an impulse wave is the price can go in either direction. You can have impulse waves on the way up or on the way down. But an impulse wave, you really know what's happening when you see this. You have some kind of consolidation, and then you get a big move, right? It's an impulse. This is a consolidation. This is a consolidation, right? And then you get a big move out, a consolidation, a big move out. So if you're watching the market and it goes up or down on a day, if you don't know where you are relative to the last consolidation, you don't know if you're in an impulse wave or a corrective wave. But if you have a consolidation and the market explodes to the upside, it's very unlikely that it's going to just roll over. Because once an impulse wave is going, price is moving higher. You can have it also on the downside, right? This cascading down is an impulse move to the downside. So the implication is that the next correction is correcting this downside move, but the move after that is a continuation of the impulse move to the downside. Just like on the upside, when you have a consolidation, an impulse up, you have a consolidation that once it breaks out, the expectation is a move to the upside. So understanding impulse and corrective, just the concept of it, really, really helps to figure out, is it the market more likely to keep going up, or is it more likely to keep going down when you're in a sort of a corrective pattern? And so this is the chart of Tesla I was talking about, right? Tesla bottoms down here in 2024, had a big move up and then consolidated for quite a while. But coming off of this bottom and this big impulse move up, this consolidation, once it completed, was very likely to go to the upside from there, right? And that day right there was when everybody piled in. That's when you knew if you just drew the trend lines for the consolidation, that was the day that it broke to the upside. And then you get the impulse move up. The corrective move down, right, is this kind of ABC. It's corrective, and it got you back down to the prior high and then ripped up again. So if you fast forward to where we are now, we had a peak up here at about 500. We came all the way down to 220 and got a lot of support right there, right? Then we have this impulse move up. So a big percentage correction. You went down from 500 to 225, so more than 50% loss in Tesla, right, since the beginning of 2025 into the bottom in April. So that's a huge move down. Then you get 3 legs of support right there, a huge move up, and then now we're in this consolidation phase. So based on what I was just saying, if you're looking at this, you've got an impulse move up, a consolidation here. So the next move should be up, right? And the way triangles work in general, the theory of it doesn't work out this way all the time, but a lot of times you get to, you have your first move up, you get an A wave down, B wave up, C wave down, D wave up, and an E. And then from the E, it explodes to the upside. So all the news, this was the big drop in Tesla this week. All right, this is a daily chart. So that was, whatever, Wednesday or Thursday. Big move down, and everybody's talking about how Tesla is going to be crashing from here. And it could, right? It could get below this trend line and fall. It's possible. The benefit of it is you can expect, you have this A, B, C, D, E. You expect it's going to go to the upside. It's confirmed when it gets above this downsloping trend line, and it's a failure if it's below that downsloping trend line. So if you were going to buy it right here, your risk is that much. If it gets down here, you're going to sell it. So that's your risk. But your potential upside is basically the length of this. So it's just an example. I'm not saying to go out and buy Tesla. It's a really, really good example of technical analysis right now. And then Bitcoin is the other pretty good one. We had a pretty long ABC corrective, right? This was the impulse wave. We get an ABC correction. We get another impulse wave. And we have this correction right here. So there's no guarantees that it's going to break out to the upside. But that's the trend, right? If it breaks down here, it failed, and it's going lower. Bitcoin's really, it's super volatile. And so this intraday peak sucked in a lot of people. This intraday low was basically pushing out the stops of people that had gotten in up here. So if you're confused about it, or if you want to look at it on a little bit smaller time frame, this is an hourly chart. So the difference between the daily and the hourly, if you're looking at a daily chart, this looks like a horizontal consolidation and the next move is up. Okay. If you're looking at it on an hourly, you have a big move down and then this consolidation. So on an hourly, it almost looks more like this is a move down, this is a consolidation, and then there's another move down, right? Either way, when it breaks out of that range, you know which way it's going to go. So all I'm pointing out is these are patterns within time frames. So you can use any time frame that suits your, and obviously these work for all the TSP funds also. I just pulled up these because they're a good example of how to do it. Okay. All right, TSP fund charts. So each one of these, this is the C fund. Each one of these is 1 week of price movement, and the blue line is the 20-week moving average line and the relative strength indicator down here. So we're going back to, this is the peak in 2022. As long as price is above that 20-week moving average line and relative strength is above 50, right? When relative strength is above 50, price is moving up. When it's below 50, price is moving down. And we are well above that 20-week moving average line, and we still have room to the upside before we get overbought on the C fund. So notwithstanding the daily ups and downs and all the tariff talk and everything else, we're due for a pullback, right? You don't see a slope like that on a weekly basis without some kind of pullback very often. And this is definitely the summer season where we would expect some kind of pullback. But until we see some kind of indication that it's happening in the price chart, if you're reallocating to the G fund because you think something's going to happen, I mean, if it makes you sleep better at night, go for it. But the trend is up. S fund, same thing. We haven't exceeded the prior high yet, but the S fund, same kind of trend. It's up, and we have plenty of room to go on the upside and relative strength. I fund has been doing really well since it bottomed in April. The I fund this week is interesting. So far this week through Thursday, it's up 2% versus the C fund is up 1%. So I think what's really interesting about that is, did the Japan tariffs help Japan more than it helped the US, right? And is that going to kind of translate going forward? The dollar got a little bit stronger this week, so it's interesting that the I fund did as well as it did, given that the dollar is kind of strengthening. So we'll have to see. But the I fund it needs a pullback, but it's a great option right now. But it is kind of now above that 70 level, so it's overbought. F fund cannot get above that high. This is an ascending triangle. So there's a lot of upward pressure because every time it pulls back, it hits that trend line and goes higher, but it can't get above this peak. So once it breaks out of here, it should take off, which for us, it doesn't really matter because you're going to be way better off in the stock funds if they are going up at the same time that the F fund is. The F fund is only really useful if the Fed lowers rates because stocks are falling. In that case, the Fed lowering rates drives up the price of the F fund, and you do way better relative to stocks if they're falling. So the F fund is a really specific tool. And then the G fund keeps going up and to the right. There's nothing wrong with the 4.2, 4.3% rate of return in the G fund. If you think that there's just too much going on in the world and you're worried about things, there's nothing wrong with the G fund. It's a really good rate of return. It's just that you're not doing as well as you could if you follow the actual trend of the charts.
Yeah, all that's based on your risk tolerance, right? We talk about that all the time. If you guys have any questions, shoot them to us in the comment section wherever you find the video. If there's no comment section, you can always shoot us an email at support@growmytsp.com, and the support team will get it over to us. All right, guys. Hope you guys are having had a great weekend and a great week coming up, and we will see you next time.
All right.